All right, looks like we're live. Welcome everybody to Live Valuation. I'm Minus Moriarty, and today we're going to be taking a look at ticker BKE, The Buckle. This is a little bit of a redo of the last valuation that we did. We kind of ran into some issues trying to deal with some sound, kind of had to cancel the stream partway through. Wasn't really audible for most of it, sounds like, so we're just kind of redoing that, which is fine because this company I think is actually a very, very interesting one, so it's worth the redo. Anyway, taking a look at our watch list here today. I actually do have the company kind of already listed up here. It being listed so high with such a high value score may be an indicator of why I definitely wanted to recover it. Though it's worth noting that over the last couple days, I've actually totally redone my value score thing that I have for valuing or ranking all of the valuations I have according to some more qualitative criteria. I just kind of like sectioned out some more quantitative measures versus qualitative measures, and kind of like two separate things. Kind of have that reconfigured here, but Buckle kind of hits on both categories, which are the ones that are really, really good are highlighted green here, as well as the number itself being really good. So you can see that it's kind of in ranks with some of these other really, really high ranking companies according to this new methodology, which include America Sport Outdoors, Sturm Ruger, some older valuation for that one, Hibbett, a more recent one, Invesco, another more recent one. I did buy into Hibbett, but Invesco doing so well on this is kind of making it even more appealing. Hey Nukit, how's it going? Hopefully I am more audible now. I did rework all the sound settings. I only kind of like partially figured out what the problem was last time, but either way, looks like we're good now. So continuing with that, other companies that kind of ranked out pretty well as well were Fidelity National Financial, which is my longtime really large holding, so that's really good, as well as Smith & Wesson, another one I do not hold, but I've been kind of looking at more recently, so that's also more interesting. But then the one we're going to look at today, again, the Buckle, ranking really, really high. So we'll see how that works out. Good, glad to hear it. Glad to hear that you guys can hear it and all that. So anyway, getting into the Buckle. It's another retailer, specialized apparel, shoes, and clothing retailer. Kind of in line with Foot Locker in some ways, but also in line with kind of sporting goods or Big Five kind of thing, a little bit kind of halfway between the two. It definitely has a very high shoe focus, but also lots of denims and jeans. Some again in line with some of the other retailers, kind of like Foot Locker or other clothing based ones that we've covered. Still, either way, putting it in the retail special line industry, commanded with the unlevered beta of 1.09 and the expected sales capital ratio for the industry of 2.99 and the net margin of 5.77. They only operate in the United States, so their equity risk premium is basically only in line with that, and they have a debt to equity ratio currently of about 19%. So with that, we come up to a cost of equity for them of 9.88 against their market value of debt, which is a little under 300 million or so. We have a weighted average maturity for their debt of about 4 years and interest rate of 3.7%. So not bad on the interest rate. It would be nicer if the maturity was longer than our current projection period, but that is what it is. So either way, moving in line with that, we can take a look at their financial history a little bit. Mickey, chill out. Taking a look at their financial history, it's definitely nothing super impressive as far as like the revenues go. You can see that from 2012 on through, they kind of were relatively flat through 2015, and then through 2016 down through 2019, they kind of had a little bit of a shrinkage of revenues over the period, and then they kind of had a very nice spurt in their revenues in the last year or so. So it's not exactly a great growth story per se. This is definitely more of just a pure valuation play. But it's also what I'm going to consider to be a really, really good example of a dividend stock if you're interested in that type of thing. I honestly think this is possibly one of the best high value dividend stocks I've found as far as like quality of the type of dividend stock, but I'll get into that when we get to the cash flows. So taking a look at their gross margins, you can also see The gross margins were also kind of in line, 44 to 43% as the low for that same till 2015 period. Then it dropped to 40% during these lower revenue growth periods. And then it's kind of spiked back up to 44% in 2020, and then now up to 50% in the most recent year. So it's pretty safe to assume that they'll probably drop back down to some sort of like 40% margin line, which would then turn down into a drop of the operating margin, which also had a really large spurt during that period. If we take a look at the net margin overall through the period, you can see that it itself also took basically the same trend, 13, 14%, dropping down to 10%, 11%, with 9% kind of thrown in there, but about 10% as an average or so. And then it jumped up to 14 to 19 to 20%, showing that the average over the last 2 years is 17%, which we're going to use as our base year because we think it'll probably drop down for this, but then we're going to probably coast downward on their margins overall, down towards probably like a 10 to 11% in the long term. I can't remember. I think that's what I put in. Well, I have 12 to 15% here, but maybe we'll adjust some of the assumptions on that a little bit in a minute. But yeah, so I think it's safe to assume that they're probably going to come back down to this 10 to 11%, but probably be able to maintain maybe a 1 or 2 percentage points higher than that based off of where they were prior to 2016, which the average for that was 14% versus, what was it, 10.5% here. So if you kind of like think about maybe halfway between that, that would be like 1.75 percentage points higher than this, which would be, what is that, 12.25. So maybe that is kind of like a good midpoint for the margins. Is that what I had? I have 12.5 here, 12. So yeah, that's kind of, I think that was kind of the logic I was using when I was doing that, but we'll get into some more of that later. Again, getting to the cash flows, you can see that the adjusted net capex, which takes all of their capital expenditures and also nets it out with the depreciation over the entire time frame, as well as includes acquisitions if they had them, though they didn't. You can see that they had a negative number here in 2012, but then positive numbers up through 2015, showing that they actually were doing investments in the business. And then after that, during the periods when the revenues were dropping, they actually had more negative years as far as capex go, discounting the relatively small number here in 2018, showing that they've been kind of de-investing in their business and actually liquidating some of the poor assets, which didn't seem to be doing a huge benefit for them earlier on. But it is interesting to show that they managed to get the huge revenue growth in 2021 without actually having to do a huge amount of capital expenditures in this year to do so, unlike plenty of other companies. So maybe that shows they'll have to do some capital expenditures more in the future or not. That kind of depends on where their current capital base is, but we'll get into that on the sales to capital ratio. I don't think that was an issue if I remember before, but we'll see when I get back down to that side of the page. But looking at the free cash flow to equities, and looking at it versus the total common payout over the period, you can see that they've basically not done any share repurchases over the period. They do have a small amount authorized. It's basically the same amount they've had authorized since like 2010. And they basically don't do any. They did a very small amount in the depths of 2020, a very small amount, but they did do them at the right time. But this company just doesn't seem interested in doing buybacks. What they do is dividends. They have a regular dividend they pay, which is currently expected to be about 4.66% yield. But then they do special dividends every year or every other year to kind of bolster that. And that actually ends up matching up with the free cash flows to equity, which is one thing I really liked. If we can see, because I complain about this all the time with companies that pay out their cash flows, they often pay out too much of them, or possibly they're not paying out enough of them too. That's possible as an issue. But lots of companies pay out too much of them and they're doing share buybacks, but they're actually doing it in the form of taking on debt in order to do so. But the average free cash flow to equity they had from 2012 to 2016 is 142 million. The total amount of share buybacks that they did on average during that time frame, 142 million. For the next 5 years, 2017, 2021, 163 million as an average. Total amount that they paid out, 164 million, which really is just kind of a rounding error in Excel. It's not actually necessarily more, because if you actually look at all 10, they both show 153. So it's the payout ratio. Well, it's probably effectively close to 100%, depending on whether or not the free cash flows are in line with the net income. See, the free cash flow equity is on average over the entire time frame 153, and the net income over the entire time frame is 141. So their total payout ratios, according to net income, is probably like 110, 120%, but it's not actually costing them cash. That's the point. Their cash flow covers the dividends just fine. And another way that you can show that this works out is by looking at the cash balance on their balance sheet, which is what I was going to get to next. You can see from 2012, it's gone from 117 million up through this time frame to 253 million. It was even already up to 220 million in 2019 before the huge spurt in revenues and profits they had in the most recent 2 years. So even before the most recent year of huge profits, they were already building up cash. Even though they're paying out this huge amount of cash in the form of dividends, they're still building up cash. And then you might say, well, maybe they're not paying their bills. What about that? So let's take a look at that. Total current liabilities went from 128 million to 248 million. So sure, they did take on 100 million more in current liabilities, and they went from 36 million to 200 million in long-term debt. But I mean, let's think about it. That's like $250 million grown in debt liabilities. Their shareholders' equity has also grown from 289 million to 312, and their retained earnings have gone from 172 to 145. So yeah, their retained earnings have shrunken slightly. That's the only part where you could say that that's an issue, but it hasn't actually made their shareholders' equity go down because their assets have actually grown faster than their liabilities. So I'm not concerned about it, but that is one thing I would say about this company, is that if you're not interested in a company that pays out the vast majority of their cash flow as dividends, this isn't going to be the stock for you, because that's exactly what this company is. They're basically the perfect dividend stock. They pay out exactly what they can pay and not a cent more. And I love it. That's awesome. You know, not everyone loves dividend stocks. I wouldn't make my entire portfolio all dividend stocks, but I like a good dividend stock here and there when it's really well managed. And so that's one of the things that definitely interests me in this stock to a certain degree. Not to mention, it's also very undervalued. So they're going to give you all of the returns in the form of dividends up to the cost of equity, effectively speaking. But then beyond that, it's really just going to be how much you bought the stock undervalued, and that's going to be your capital appreciation, which the stock is somewhat undervalued. So there is capital appreciation to be had. Now, taking a look at what the effect of those cash flows actually have, you can see that the returns on invested capital are really, really strong over basically the entire time frame. I mean, we had some 50s, 60s, and 70s numbers way back here. And so once we drop into the 2016 after period, it kind of drops into the 30s, a teen number here in 2019, but then back up to the 30s in 2020. And then it's back up to the 70s with this really high profit here in 2021. So I mean, over the entire time frame, we're looking at an average of a return on invested capital of 49.5%. Over the last 3 years, it's averaging 42%. So huge returns on invested capital. And then the returns on equity are also just insane. Over the entire time frame, it averages 109.5%. Over the last 3 years, 220%. So, you know, pretty astounding financial metrics, and they're not doing it on the backs of share buybacks. That's the other thing, because like other companies, when you see, yeah, really impressive. And when you see companies with these types of returns on invested capital and these types of returns on equity, usually it's because they've done so many share buybacks that they've like eaten their equity down to a tiny little portion, and it makes their returns and equity so huge. So the fact that they've done this with like almost no share buybacks, they literally did $3 million worth of share buybacks over the 10-year period. $3 million worth of share buybacks. And I mean, their average market cap was, what was it? 1.6 billion. So effectively, they did no share buybacks. That's basically the point I was saying. And they still have returns on equity and returns on invested capital that strong, which just shows that it's just a well-managed business. So yeah, like I said, dividends may not be your thing, but this is like one of the most well-managed sets of financials I've looked at in a long time. So that's kind of one of the things where it's just like, man, I might take a small bite out of it. You know, you don't necessarily want to make dividend-only stocks necessarily a huge portion of your portfolio, but I think it's a pretty good opportunity. Not to mention, it had some other features that were interesting about it. There's lots of inside ownership, a huge portion of inside ownership, enough that it takes a huge portion of the shares actually off the float. I think I didn't get into all the details related to that, but I'm pretty sure it comes back from when it originally was owned by some of its original family shareholders, I'm pretty sure. Or maybe I'm mixing up with one of the other companies. I was kind of looking at several companies simultaneously. But we'll look at that on Yahoo in a minute here, perhaps. But moving down to the sales to capital ratio, very much in line with lots of other high sales retailers. They typically have very high sales to capital ratios, but this one is no exception. 3.67 being the average over the entire time frame. Or in the more recent year period, it's like 2.57, but it also jumped up to 3.73 in the most recent year period. So we can probably assume that it kind of goes somewhere between 2, 3.5 for the sales to capital ratio, which the sales to capital ratio is effectively how much revenue do you get for the amount of capital you have invested in the business. And I use this as a measure to think about how much reinvestment goes into the company. So now we'll get into looking at the actual valuation. As I was kind of saying before, I mean, I already looked at a lot of stuff on here and put some projections in. This number is, I don't think, necessarily too far off from what we might do. We might make some adjustments, but it is undervalued. So there's currently more than dividends to be had on the stock. But looking at the revenues and kind of a small look of looking at the company. Oh, that's right. I didn't actually make a revenue model for this one, but I wanted to show that inflation, well, I mean, it's going to have the same impact as it's going to have for basically every company, which is it's going to squeeze their margins. I don't expect this to be any different for them. I'm as we can see that they had the huge jump in their margins in the most recent year, which is very much in line with basically like all the retailers in the last year. And yeah, absolutely, people will definitely be buying less discretionary. That's definitely going to be a thing. Keep in mind that like Buckle, I would say, is kind of on the line between discretionary and defensive because it's clothing. In my opinion, like, if you look at all of the discretionary things to be buying, clothing is the one that's like maybe the closest to being defensive, depending on the type of clothing you're in. If it's like really high margin branded clothing, then maybe that's different. That's more discretionary, but fancier clothing is more discretionary. But like denims and shoes, which is what Buckle sells a lot of, that's closer to needs than other discretionary. It's less needs than food, obviously, or medicine and plenty of other things like that. So it's like, it's still discretionary, but like I would say it leans more on the end of people will still be buying these things. But so I don't think their sales will be affected as much by inflation as much as other discretionaries. But I do think that their margins will be squeezed. Like all margins will be squeezed for inflationary, which is part of the reason you saw a huge bump up there. There is some in my state. I actually haven't been to one, but I'm very interested in going to do so. If I decide if I'm gonna take a look at it, I probably will go look at one of their stores. Here, I'll pull up the 10K. They did have a list of their stores in here, but this is yeah, like I said, I haven't gone there yet, but I do plan to get some scuttlebutt in if I have the opportunity to. Like some of the other retailers that I've looked at, they just weren't in my state before, so I never could have had the opportunity to go do such a thing. But they do have locations in my state, and I plan to go look at them. But yeah, as you can see here, 40% of their business comes from denim, right here, and 30% comes from tops. So, I mean, denims, I would say, are much less on the discretionary side. Tops, it kind of depends. The tops can depend. Footwear, it also kind of depends. Accessories, that's going to be pretty discretionary. Sportswear, that's going to be more discretionary. Outerwear, that might be more discretionary. Yeah, so it's like if you just look at like the merchandise grouping of their stuff, it is discretionary still, but clothing, sales, I think will be less affected. Margins more so affected. Anyway, now moving down the line here, you can see the list of locations for the stores. They have 440 stores. Stores all over the place. So I mean, if you want to take a look at some of these stores, go ahead and look yourself. If you can't see the list right there, I'm not really super cared about doxing myself. I am in Arizona. There's 12 locations apparently. So yeah, I plan to go try and take a look at them. But there's lots of locations to be had here. And then this is one of the other things I was going to show, this total number of stores per year. They have the entire list from 2012 to 2021. You can see that they did have a decent amount of shakeup of stores over the entire time frame. You can see up through that 2015 period, they kind of had a more consistent opening series going on. And then it kind of shifts to a little bit more of closures from 2016 onward, which shows the liquidation of the net capex that I was talking about. Yeah, even one in Alaska. They're widespread. But I'm not sure where the locations necessarily are, like how much of it is like an urban focus versus more of a rural focus. So it's like I'm not sure if they're like in the major city centers of these states or not per se. Like I said, I've never been to one, but apparently there's 12 in my state, so I plan to try to go check one out. But yeah, getting on with what I was saying. The open at the end of the year figure though over the entire time frame has gone from 440 to 440. So overall, the entire time frame, they've basically not shifted their business around. They've just kind of well, I mean, they have shifted their business around, but they haven't grown their business. They've just shuffled all of their stores. So that's the fact it's going to have to be a good online store. They did have an online store. I mean, I don't really know how good it is because I've never used it, but I at least saw that it had a functioning online store when I was looking on the investor webpage. Here, I mean, here's the corporate page. Let me go back to the shop buckle. There you go. Shop buckle, shop mem. Take a look at it. Bush racing. Yeah, I don't know. Shop women. Yeah, so I mean, I don't know necessarily how good the buying interface is because I haven't used it, but I mean, they have one. They certainly have one. So anyway, as I was saying, because of the fact that their revenues haven't really shifted, their stores haven't really shifted, I'm kind of looking at them more in steady state. I didn't really build a revenue growth model for them. I'm really just kind of thinking of them as basically flat, and I'm kind of thinking about them relatively flat in terms of most of my assumptions as well. We'll shift some of these around a little bit. Like I said, these don't necessarily have to stay, but if I remember, I don't think the shifting the revenues actually even affects the value that much. Yeah, basically that was kind of my opinion. It's like, it doesn't seem like it's my type of store per se. Granted, I'm not really a huge style person, admittedly. So it's like, I'm not really a cares too much about his clothing type person. But yeah, it looks like a pretty good business. And like I said, the financials, like, I don't know, I look at valuation very much from like an accounting perspective. And so I see financials that are just like that precise. It's like, you guys had this much money you could have paid out this year, and that's like exactly what you paid out to your shareholders. It's not the same every single year, but over any 5 to 10 year period, you're paying out exactly what you should. That's grand. That's fantastic. The margins are well operated. Like as we were saying below, the industrial grouping of basically all the retailers, and we've looked at several retailers in this space now on this channel, and basically a lot of them kind of fall in line with this, where sales capital ratio relatively close to 3, 2s to 3s kind of range. That's what theirs is. But then the margins, a lot of them have these kind of mid single digits kind of margins, not great margins, but now these guys have a much healthier margin. You can see that they have single digits generally across the board. There's only one or two numbers generally off of that when 2017 or 2019. So I was kind of reading your question while I was talking. Yes and no. I mean, I kind of do a little bit of both of it, but it's definitely taking a very top-down approach. It's an investor approach. It looks to me like the people that run this business understand valuation and are investors. Or some of the people who are financing them are investors. And I think that that's generally true. We'll go over to Yahoo, looking at the company. It's worth noting here, this is the assumptions. There's only 2 analysts projecting for this year and 1 analyst for next year. So very small analyst coverage for this company. But they're projecting 3.9% growth this year, average of 1.34 billion. 5.8% growth next year, 1.42 billion. So they're not actually projecting downward movement for the revenues. I am going to put that into my assumptions, but either way, that is what they have on here. They also have the EPS growth number of 8% per annum for the next 5 years, but that number is usually a little bit behind the factor, so it could be way behind and not really relevant. But taking a look at their holders, like I said, 39.8% of the shares held by insiders. So like 2 out of 5 shares are basically off float because they're kind of privately held shares by some of the original owners, I'm pretty sure. So there is a pretty low amount of float for the stock in a general sense, and that high insider ownership does relate back to, I think, to the way it's managed. I think it's a very investor focused company because frankly it's just owned by investors. So again, maybe it's maybe not the business that a lot of other people necessarily want. A lot of people don't like companies where 2/3 of their returns might be in the form of dividends, but because that very well might be the case for this company if you invest in it. But either way, it's going to be high returns. That's the point. It's like that might be the case. And the fact that they do it also on this kind of shaky basis, it's not just a consistent dividend. That basically means that they're more than willing to not pay the special dividend if they have to. They don't pay the special dividend every single year. You can look at their dividend. This is the one that they currently have for the regular dividend, but you see like $6.99 per share 2021, $2.60 in 2020, $2.30 in 2019, $2 in 2018, $2.75 2017, $3.66 back in 2014, $5.30 back in 2012. So sometimes it's just $2 per share for a dividend, and other times it's $6 per share for the dividend. So, you know, it's a little bit all over the place with the dividends because they're paying out what they can pay. But that also means that if tough times come, they're not going to just keep to the same dividend schedule and drain the company of all their funds because they're too scared to lose their 10 years or whatever on the record, or their 20 years dividend aristocrat status. You know, like it's cool having the dividend aristocrat status, but sometimes it makes management do stupid things just to try to keep it. So I think that's worth noting. That's one thing that's good about a company that shakes their dividends around. Like you see that in the mining sector a lot. Like mining and commodity companies are not afraid to pay weird special dividends all over the place. But for a retailer, that's kind of pretty strange and different. The average dividend per share, let's take a look at that over the entire time frame. The average dividend per share for the 10-year period was $3.13, which came out to a dividend yield at the based off of the price at the end of the year for that fiscal year of 9.82%. So almost 10% average dividend. Yeah. So that's what I mean, where it's like they're basically paying out their cost of equity in the form of a dividend. So if you bought them at fair value, basically all of your return would be dividends. Either cost of equity is 9.88%. So if they weren't 42%, if there wasn't 42% returns to gain from the upside right now, if you just bought them at fair value, basically all your returns would be dividends. But because they're undervalued, there's more than dividend to get right now. Yeah, it's pretty nuts. And like I said, there's reasons why the market wouldn't like it. It's not a huge company. It's not a micro cap. It's 1.5 billion, but it's not a huge company. So that's going to take a lot of people off the table. It's going to have that shaky dividend record, which means that the dividend ETFs aren't going to really pick them up that much because of the fact that they don't have a consistent dividend record. It has the high insider ownership and the low float, which is going to keep lots of other bigger investors out. There's lots of reasons why people wouldn't get on it. Not to mention, again, we saw that it has very low coverage, has only about 2 analysts covering it, really. So there's a lot of reasons why Big Wall Street would not be hopping in on this train. It's not just that you have to be like, oh, well, what's the catch? Why do they have a 10% dividend yield? Obviously, again, it's a special dividend yield, on average 10%. The regular dividend that they currently have planned is 4.66%. So that's what you can currently expect without any special announcements. But maybe every other year or so, you'll get a special dividend. Is basically what it looks like. It's like about every other year. So yeah, we can take a look at some of the projections that I put in for the company. I am using the last 2 year average for the revenues as my base. Kind of keep an assumption that they will actually drop their revenues. I'm assuming that so you can see the expected revenue that I have is about 1,100. So I'm actually assuming that there might be a 12% drop in revenues on an expected basis this year due to recessionary concerns. As I was saying before, the analysts don't seem to see that. They don't seem to be concerned about that, but I'm a pretty conservative investor, so I'm just baking that in here from the get-go. And then I assume that they will grow a decent bit past that, which is part of the reason I do have a little bit more positive end here, because it's basically this growth rate, the -5% and the 10% is basically after that, getting down to that base level where we're going to grow after the fact. And then that's going to lead us up to -8% to 6% over the entire time frame, as well as I'll probably move the midpoint number here maybe downward to 4. So that brings my expected revenue growth over the entire time frame to 0.44, roughly flat. I'm going to assume that their revenues will basically be flat over the entire time frame, which basically means if you think about it in real terms, I'm assuming that in real terms the revenues are going to go down, because I believe that inflation is going to happen over the entire time frame, which means that the real amounts of their revenues are actually going to go down, which I think is in line with the fact that we were seeing a downward trend in their revenues before 2020. So I'm going to basically assume that they're going to go back to that downward trend, but that it's going to be kind of coasted by inflation a little bit. They'll be able to actually kind of coast it by raising the prices as they've done a little bit. However, as I was saying before, that is going to have a negative effect on their margins. The margins, we are I have it on the 2-year here, but I think we'll actually go ahead and put it as the 3-year. So we're going to assume that their margins are going to actually drop down pretty significantly in the next year, down to kind of an average of around 14-15% from this 19 to 20%. So we're immediately assuming that they're going to take a hit to their margins with the hit to their revenues. And then from there, it's also going to coast downward to about a 12% or so, which I might trim this back a little bit to get that expected level to around 12. Yeah, 11 to 12. So that's kind of the margin I actually kind of want to assume for that. And that brought down a little bit of the numbers on there, but that doesn't shift it overall too much. And then the sales to capital ratio assumptions, I kind of have it assuming that it's going to stay a little over 3.5, which is roughly in line with kind of the sales to capital ratio that they currently have, a little bit lower at the current level, but also similar to their longer term average. So pretty in line with most of the similar things. Where do these guys get their products? That's, I don't think, a huge part of their freight costs is, because they do actually sell quite a lot of American brands, but they undoubtedly would have a decent portion of them. I actually didn't look into some of that specifically, admittedly. I definitely am not, I don't necessarily do a lot of those over specific detail lookups. They probably do have some of that details here in the 10K. Usually if you go down a little bit lower than where I currently where they talk about their competition, there's probably an area where they talk about their inventories and product sourcings. But I honestly wasn't overly concerning myself with some of those details, because of the fact that, like, you can see just how well they were able to keep their numbers up in 2021 during a lot of the other supply constraints. They had such a huge burst of it, and also the way that their inventories have kind of stayed pretty bolstered through the period. I honestly just wasn't making a huge concern about it. Unless a company operates overseas and has facilities overseas, I don't make a huge concern about it. Hey, how's it going, GT? I saw you hop in the chat there. Since they were operating entirely in the United States and they also had all their assets in the United States, I basically just was like, I'm not going to make a huge concern about it. I worry about things like that for more like the semiconductor companies that have all their stuff overseas. But you can take a look at their inventories. Their inventories are also basically about the same as they were at the start of the 10-year period. They're lower from what the average was over the entire time frame. The average inventory they had was 120 million over the 10-year period, but it went from 103 million to that average of 120 and then back down to 102 here. So you could argue that maybe they should have a little bit more inventories relative to other things, but I also think that a lot of companies built up too much inventories in the last year because of worrying about supply constraints. And so I actually kind of like the fact that their inventories are at literally the same dollar level as they were in 2012. That kind of makes me feel a little bit more comfortable possibly moving into some of the more recessionary problems. Yeah, and that's another factor too. If you go look at a lot of the inflation reports, if you go into the subcategories of the CPI reports month by month, go look at clothing and textiles over basically over the last 10 years. That's like some of the least volatile prices in the consumer price index has been clothing, right up there with telecommunications. It's like telecommunications and clothing and smartphones generally been like some of the better items as far as it go. I know people who own iPhones probably don't think smartphones are that cheap, but it is true that technically if you include all of the band from expensive to cheap ones are included. Anyway, I digress on that. So moving into further assumptions, I did cover the sales to capital ratio. Taking a look at the debt to equity ratio, as I was saying, it's already 19%, and they have a 1.5 billion market cap with about $300 million in debt. So I don't know, you assume maybe that they take on twice as much debt, which, by the way, I'm pretty sure all of that debt is in the form of lease liabilities. So it's not even enlisted debt, it's leases that they could technically just roll over. But if you assume maybe they double that, which is pretty unlikely, and then they also have a pretty significant drop in their market cap, then maybe they get their debt to equity ratio up to 50-60%. But that would require some pretty negative consequences. And then because of the fact it's lease liabilities, I think it's pretty possible it drops to 0% in a best case scenario. So that's kind of the range, 0 to 50% as a debt to equity ratio. 20% is where it currently is. I just could have left that there. That leaves our expected range of about 24%. So that's pretty much all of the assumptions going into the valuation. Do need to kind of maybe check the default risk here and adjust for that a little bit. I did kind of look at this a little bit last night, I'm pretty sure, so I don't think there's too many things to adjust, but let me just double check. It's just the risk of whether or not they'll be able to refinance their debt in the chance that financial markets close down, which for any company that doesn't have a huge amount of debt, that basically is an almost irrelevant concept, but I still like to check for it no matter what. So that gets us to kind of our final valuation for BKE Buckle Inc. As I'm kind of calling it. It's kind of the perfect dividend stock, I think. Go ahead and do me a favor. If you guys are watching and you're enjoying the content, please give me those likes. I see somebody already did, and it's much appreciated, but we could definitely do with more to attract more people to the channel. So 5 years. Oh, today we have U.S. Treasury selling for 2.837% or so. Mature market equity risk premium, I have 5.65% currently. Wow, it's pretty crazy to see how much that's come up over the last year. It was just around 4% not terribly long ago, but equity risk premiums being priced by the market are moving upward, which is making discount rates moving upward pretty significantly. One of the reasons that stock prices are falling, by the way, is just the treasury rates are increasing, but so is the equity risk premium people are pricing in. Discount rate I get for the company after adjusting for company specific risks, I get 9.88%. And the dividend yield that they currently have planned, as I said before, that's just the regular portion of their dividend, not counting any special dividends that they pay out approximately every other year or so, about 4.66%. They had sales 5 years ago of $975 million, and in the most recent year it was 1.2 billion, 1.3 billion or so. 5.84% sales growth each year for the last 5 years that comes to. A sales capital ratio over the last 9 years on average of 3.67 compared to their industrial expectation currently of 2.99. So relatively strong capital efficiency compared to their industry. And returns on invested capital over the period of 42%. So very, very strong returns on invested capital. And the debt to equity ratio they currently have is about 19%. They have basically no major default risk in the most recent year period. And in the most recent year, they had profit margins of 15%. Very, very huge profit margins. Again, actually, no, never mind. That was the last 3 year average, 15%. That's right. Very, very strong profit margins, as we talked about, probably not likely to be sustainable over the period, but either way, much higher than the industrial expectation of 5.77. Even the numbers that we're projecting for them is much higher than the industrial expectation. So that's just one of the reasons I think it's a very good company. Very, very high quality financial metrics across the board. They clearly have a strong position as far as like the margin pricing on everything. I don't know if that comes down to how they organize their sales and general administrative. I'd have to do a lot more specific look into the companies. Like I said, I've only done so much research on this one at this point, but I just thought that these numbers were very, very outstanding. Either way, profit in the most recent year, $255 million. They're currently selling for $30.04 per share. Our probability distribution is pretty much our typical normal distribution or so. We have revenue assumptions of 850 million in the worst case scenario to 1.7 billion in the best case scenario. On an expected basis, we're seeing 1.3 billion, which comes to growth over the entire time frame of -8% per year for the next 5 years in the worst case scenario to possibly 6 to 7% on the best case scenario. On expected basis, we're seeing slightly positive. So as you can see, the potential for growth, we're putting it in as less than the potential for downside, but we're also kind of tilting towards the more of the flat end of that is basically what we're doing here. So we do think it's more likely that they're flat with maybe even slightly high on a nominal basis. But again, we said that in real terms, that would probably be a fall, which would make sense. But there is potential that maybe their competitive position just falls off a little bit faster than you would hope, which is why we're kind of leaving that kind of lean in there. Sales capital assumptions, we have a distribution. It comes to an expected number of 3.58, which is a little bit lower than the most recent year, but puts them basically in line with what their long-term average has been. Returns on invested capital, we're seeing 42 to 43%, which is basically also in line with what their average has been. So we seem to believe that they'll be able to sustain that, which is pretty interesting. We do think that they might take on a little bit more debt as far as the relative market weightings of the debt to equity ratio. That might be just their market cap falling in the short term, but possibly them taking on more debt. But it's also partially just the way I like to be more conservative, just assuming they're going to take on a little bit more debt, assuming that that's not going to help them. Most companies, that's not going to help them. But anyway, on the assumption of taking on more debt, though, they don't really have any major default risk, less than 1% per year on that assumption, so no problems there. And profit margins, we have a distribution of anywhere from 6% to 17%. On an expected basis, we're seeing 11 to 12%. This is the part where definitely a large part of their value falls. Their I mean, also their capital efficiency is a major factor. Those are kind of the two major factors. But revenue, honestly, didn't have a huge effect on them. You could play with the numbers. I did before. You could make it so they shrink a lot or grow a lot. It doesn't even really make their value change that much. It really kind of comes down to what their capital efficiency is and their profit margins is for this particular business model. Just because of the way that the numbers kind of work out. So you could argue that maybe I'm being too pessimistic by assuming that they're going to drop to 11 to 12%. You can also argue that maybe I'm being too optimistic that they're going to go back to that kind of longer term average over the 9-year period. And instead, maybe you think they're going to drop down to that that kind of average they had during that lesser period from 2016 to 2019, where it was more like 9 to 10%, which would drop a decent amount of the value off. Though I think it would still leave them as somewhat undervalued. But either way, that gets us a profit distribution of anywhere from 51 million to possibly 301 million to, on an expected basis, 158 million, which gets us a present value using the discount rate that we came up with of $40.06 per share, which is 33% higher than the current share price. We have 5-year forward value targets unadjusted for the dividends that they would pay out. So that's one thing you would have to keep in mind here is, like, I say that every time when I do this, is that these value targets are unadjusted for the dividends that you would pay out. What that means is that this number includes the dividends. So that's the thing. It's like when I say that it's going to reach a price target of $64, it's not actually going to reach a price of $64. It's going to reach $64 minus whatever dividends it paid out over the period. So if it paid you $10 worth of dividends, the stock price is going to be $54, but you're going to have $10 in your pocket. So let's just understand that about this column. I say that every time for every valuation, but I feel like it's especially important to mention here with this stock that we know is going to pay out probably 9 to 10% in dividends per year. So, just keep that in mind. It's probably not going to reach this price. It's going to give you the value. That's what this is, the value that it's going to give you. I don't subtract the dividends out to try to come up with what that price is, because I don't really know what dividends they're going to pay out. Like, I don't do that for any company because I don't know what dividends are going to pay out, but especially not for this one. That would be really difficult to figure out. But either way, so anyway, long digression there, but I kind of wanted to make sure that caveat is understood. Like I said, I say it every time, but I want to make sure it was understood, especially for this very, very high dividend paying stock. But we have 5-year forward value targets unadjusted for the dividends that they'll pay out of anywhere from $21.67 to $129.06, which on an expected basis, we see $64.16, which when you compare it to the current share price, that gets you an implied return of 16.39% per year for the next 5 years. Yeah, just dividends get taxed. Did you put that in the calculation? Well, they do get taxed, but no, that's why I don't subtract them out, because I don't know what your tax rate is. Like how could I possibly? This is for everybody. Like, I could put my tax rate in, but do I know what my tax rate's going to be 3 years from now anyway? Do I know that? So it's like it opens up the can of worms once you try to adjust the value for dividends. It opens up all sorts of cans of worms because people do it. People try to make assumptions on that, but it's hard to make a price target more than 1 year out, because a company will often give you enough information that you can make assumptions about that for maybe 1 year. And then even then, you're not going to make the tax assumption. That part's going to depend on the individual, because every investor has a different tax situation. So you can't really put the tax effect of the dividend into this, because that kind of depends on how that works. But that is worth noting. That is something you should keep in mind, because as we were saying, that they're going to maybe pay 9 to 10% in dividends per year on average. Well, I mean, I don't know, if you're paying 15% in taxes, then that means actually you're going to be getting 8.5%, right? So keep that in mind. That's a factor. 15% was probably maybe high for dividend tax. I don't know, depending, whatever, depends on the circumstances there. I was kind of using more of an income tax thinking for that number. Obviously, though, 15 is just kind of the number I think about when I think about taxes for myself, but that's me. And that's a federal number. Obviously, then there's states. Some people have state taxes that are way harsher than others. So getting involved with the taxes, that involves so many other factors that it just makes it difficult. But whatever. So either way, 16.4% per year. So again, assume as we were saying, maybe 10% of that is going to be in the form of the dividend, which you're only going to actually be able to keep about 8.5% of it because of the taxes. But either way, that means 10% is going to disappear from the value. And that means that maybe there's about 7%, right? That means there would be about 7% of capital appreciation per year left over, is what that kind of comes out to be. Something about that. So yeah, it's a stock that's on the face of it is like a pure dividend stock, but at these prices, there's about 7% capital appreciation plus 8.5% post-tax dividend money. That is basically approximately. So yeah, interesting company. As I said, I'm very interested in it. I'm very interested in it. I'm gonna go check out one of those shops because I do have the ability to. I don't know where the closest one is to me. Hopefully it's not terribly far, but I mean I'm pretty close to major urban centers, so I don't imagine one's far from me if there's that many of them in my state. So very, very interesting company. I'm going to be taking a look at it, but as I said, I would kind of maybe limit the size of it, maybe due to the fact that it is a dividend stock, or maybe because of the fact that it has such a high inside ownership. That always means that there could be weird liquidity issues. They could always decide to drop a portion of their shares on the market quickly. Sure thing. I'll try to remember that on a follow-up stream. I'll try to make it happen soon so that we can have that conversation soon. But yeah, so very, very interesting. But also I had at the start of the stream, I was talking about how I've kind of changed my value score number around, so that the value score number that's kind of listed here is actually basically more purely about valuation and the comparative of the best case and worst case scenarios. It doesn't include the qualitative factors as much as it did in the past. I include something related to the returns of invested capital, but I kind of took the sales to capital ratio and the profit margin stuff out for various reasons. And instead, I've kind of come up with a different list of qualitative factors that I'm going to judge companies by. But the reason I bring this up particularly right now is because the Buckle actually passed all of the qualitative factors that I listed. Which, if you want to see the list, you can join the Discord in the link in the description below. Discord has all sorts of things in it, discussions where we do all sorts of stuff, talking about portfolios, company analysis, major investments, stuff like that. But either way, as I was saying, I did come up with this kind of screening list in this post that I put right here, laying out all the specific information on it, but kind of 8 criteria that I put together to decide whether or not I think a company is a really high quality company, beyond just the valuation. The items are, first of all, I discard all the companies that are speculative industries where the majority of the revenue growth is more than a year away, or where the location of the revenue generating assets are risky, which basically means getting rid of like super growth stocks, getting rid of things like pharmaceuticals, getting rid of most commodities unless it's like a really well diversified commodity in a safe country, or maybe also getting rid of foreign stocks unless it's like in a really safe developed market that I feel really comfortable with, perhaps, I guess. But also they must earn higher than their cost of capital as their return on invested capital on their current or the expected returns on invested capital. Their sales to capital ratio must be greater than 1, or the company must possess a very strong quantifiable moat. And when I say strong moat, I mean like it's got to be very strong, super like practically monopolistic brand name, or regulatory factors protecting you. Market debt to equity ratio must be less than 100%. I'm just discarding high debt companies to begin with. The current payout ratio, they must have some sort of payout. It doesn't matter if it's dividends or buybacks, I don't care, but they must be paying their shareholders something. Otherwise, I consider them kind of speculative. Total payout over the 5 to 10 year periods must be close to or below the free cash flows equity, which is what I was talking about with Buckle. They basically hit it perfectly. I don't want companies that are overpaying their shareholders. No overpaying companies that are overpaying their shareholders if they want to be considered a high quality company. And buybacks over the last 3 to 5 year period must be made at or below the current fair value. I don't want people who are overpaying for their buybacks. Do I invest in stocks in US dollars? No, I invest in other currencies as well. It's worth noting, this list I'm saying right here isn't all the companies I invest in. It's just if they want to be considered a high quality company and be allowed to get to a certain size. I'm willing to invest in pretty much all types of companies. It's just a question of how much I'm willing to invest in it. MLPs, I don't have anything against MLPs. I don't have any, because honestly, there's usually lots of reasons why they're not so great. But I wouldn't rule them out. I would just have to find the right one. But anyway, as I was saying, and the last thing after the no overpriced buybacks, as I was saying, I don't want people paying for buybacks that are over fair value. The last one, which is actually the thing that knocks the most companies off this list, is inside ownership must be at least 1%. I want companies that are very investor focused if they want to be considered this high quality list. And that goes in line with the payout. They must be paying their shareholders, they must not be overpaying their shareholders, and they must be shareholders, essentially, is what we want. But anyway, that list is in the Discord if people want to check that out. But anyway, it's a very strict list. Like I said, I only came up with a handful of companies that made this criteria. This is the companies that are marked green on this column right here are the companies that fit that criteria. Oh, not that one. Like, it was like 18 companies, I think, made the list out of 78 valuations that I have on this list. And then all of the ones that are green on this column are the ones that are undervalued. So you can see that there's a decent handful of high quality companies that are overvalued down here. But then there's these handful of companies that are high quality companies that are not overvalued. And they include The Buckle way up here, as well as Smith & Wesson, Fidelity National Financial, Hibbett, Invesco. Where's the next one? Sturm Ruger, American Sport Outdoors. Yeah, those are the ones. So that criteria I just listed off, all those companies fit that criteria. What about if a company that has a large stakeholder like a VC or PE? I don't have any problems with anything like that either necessarily. I don't like companies that are majority owned. If they're controlled. So like on here, you can see the inside ownership. If it says more than 50%, that's a no-go for me. I don't like companies. So like if the VC or the private equity owns 50% of the company and they just have like 30% of the shares on the market, yeah, I don't want anything to do with that, because that means that they're shareholder focused, but they're only VC PE shareholder focused. It's a different type of shareholder. So I'm not opposed to it, but they have to kind of be on the same playing field as the common shareholder if I'm being involved in that. So yeah, I'm not opposed to investing in basically all types of companies, but if you add on all those extra types of risks, it just might affect how big I'm willing to invest in the company, or whether I'm willing to invest in the company at all. So like there are companies that are really high up on this list that I've been ignoring for months because I just don't want to invest in them. Like this one at the top, HOV, Hovnanian Enterprises. They're like super deaded up to the hilt. I don't have that much interest in it. And why is that bad? Aren't all shareholders considered equal? All common shareholders are considered equal because they all have common shares. But if their shares are not the same as yours, if the VC and the PE have common shares, see, I wasn't 100% sure what you meant, because technically, okay, so I kind of technically made an assumption about what you meant. I assumed that you meant that they own a portion of the company prior to when the company IPO'd, so they have a different class of share, and therefore they have different voting rights. But even if they have the same type of share, like I said, I don't have a problem with different types of shares or even the same types of shares. The problem is if they own the majority. That's the problem. The problem is if they control it, because then they can do things that's at their interest, that's not at the interest of all the other shareholders, because of the fact that they control the business. So it comes down to control. So as long as they don't have more than 50%, I'm not necessarily concerned about that. But sure, there can be all sorts of interesting shares involved and stuff like that. Because I mean, I've got investments in some relatively young companies that have earlier VC rounds, stuff like that, but it's a smaller portion of the company, so it doesn't necessarily matter to me. Like Corsair, like I'm pretty sure Corsair has some earlier round equity investors that are not common shareholders, but they essentially have warrant claims on common shares and stuff like that. So like there's stuff like that. I'm not necessarily opposed to it, but it just changes the situation a little bit on it. So either way, that pretty much is it for all the stuff we wanted to cover for that today. As I was saying before, if you kind of want to take a look at that list of criteria for really high quality, well-managed companies that I listed. You can check that out in the Discord below, as I was talking about, which there's all sorts of other things to find, just the conversation of everybody chatting for various things, as well as the Google Drive link to a bunch of resources that I provide for free to various people. Yes, thank you for showing up, Nukit. Thank you for likes. If anybody else is watching and hasn't liked already, we really appreciate it if you to give me a last minute like so we can get some people to watch it after the fact. The next stream that I'm planning to do is probably going to be HIMX, Himax Technologies. That one is the one that's looking most interesting to me next on the list, as well as this list over here is kind of the list I'm kind of looking at tentatively over the near future. It's not necessarily going to be in this order per se, but these are kind of the ones that are on my eye in the near future, partially because a lot of these companies showed up on various 13Fs in the last week. Himax being on one from previously, but EQX, XQRTEA, WSM, RGR, LBTYK, CGM, PARA, CI, NMRD, SABR, OVV. All these, like I said, who knows how many of them we'll actually cover, what order we'll do them, but those are the ones we're looking at. So either way, I'll catch you all next time. Thanks for joining the good conversation. I appreciate